Good morning and happy Friday. If you're seeing Megan, we're all jealous, right? Like I know I am. Hopefully some of you are watching this sitting outside. I do not have that luxury. Lenders are trapped inside their homes and offices. So we are here this Friday to talk about what's going on in the market. The market is absolutely shifting. I'm going to be talking about on the second half what just came out this morning with the CPI inflation. We're going to be talking about interest rates. I know Megan is going to be talking about days on market and those showings and inventory, and you're feeling it boots on the ground, and we're heading into a holiday weekend. So what does that all mean? Well, I'm going to start us out with our quote because that's where we always start. And here, this quote is going to go along with my Tuesday live this week, if you happen to see it. And it's a beautiful thing when a career and a passion come together. I had a great conversation with a newer agent on Monday, and she was like, I just didn't want to bother you because I know you're so busy. I didn't want to give your name to a borrower. I just wasn't sure. I know you're so busy. And I'm like, I am busy doing the things I love. Busy is not a word Megan and I use. I know that we are passionate to serve, that we have teams set up with expertise to back us so that we get to do what we get to do and be so passionate about this. Neither one of us put busy in our vocabulary. Our goal is to continue to be there for you, to get clients into homes, to start building financial wealth and change the trajectory of their lives. This is not busy. This is passion every day to get up and serve. So please put us on your list. Let us see you at your closing table. Give us the opportunity to serve your clients. We do this. We sharpen our saws so that we can help you sharpen yours. We put all this data together for you every single week because we want to lift up all of us. So I just want to ask, let us see your clients to the closing table so that we can continue to do this for you on a weekly basis. So with that, Megan, why don't you take over?
Awesome. So as you guys can see, I'm sitting outside enjoying my nice weather. It's about that time where it's summertime, and this is a really distracting weekend for everyone coming up with Memorial Weekend. If you have a buyer, you need to get your buyers out this weekend. This weekend marks one of the greatest opportunities that your buyers will have negotiating power through the entire summer. Typically over Memorial Weekend, we see showings decrease by a rate of about 40%. So you'll be competing against significantly fewer people if you can get your buyers out into the market right now. Conversely, if you're a listing agent, if you're putting up a listing this week, you have to understand that you're probably going to get a lot less foot traffic. And if you're doing open houses this weekend, you're probably going to see a lot fewer people come through that open house. If you made a price reduction this week, you may not be in your best favor because, again, with fewer people coming through, you don't know if that price reduction was solid enough to get everybody into that home to really make a difference in the marketplace. So if you're going to make a price reduction, I'd say wait until next week before you go ahead and do that. But without further ado, we'll go through the numbers for this last week, and we'll get everything rolling for you guys so that you guys can see everything that I've been working on for you for the last week or so. I'm still having issues getting into Broker Bay to get those showings. When I look at Broker Bay, all I get is spinning wheels when I try and go into the analytics section of that report, and I can't pull out any of the data. So I can pull out anecdotally and tell you where the showings are, but I can still only use showing time in order to get that information. When I scroll through the system and I look at how many listings are set up for Broker Bay, it looks like it's about 15% of them are set up for Broker Bay. So I could be missing as much as about 15% of the showing activity that's out there. But if I keep doing the same thing the same way, even if I do it incorrectly the same way every time, the trend line is still going to be accurate, and showings overall are down. And so we've had a big shift in the marketplace in the last couple of weeks that really took hold back over Easter weekend. Let's start out by taking a look at all price ranges. This is every home that's in the market. Pre-COVID, we'd say that you want to get your home to market no later than May, because in June, the market really starts to cool. And this year, looking at 2022, you can see that as I track the inflow and the outflow of new business, these are all of the listings coming in. These are the listings going out. We're looking at showings over here in these cells, as well as price reductions over here in these cells. You can see that there's a notable cooling pattern that started to happen. Blue means that the market is becoming less competitive over time, and it really started over Easter weekend. That's about the point where we had interest rates that were hovering around 5.5%. going on for about 2 months. And so what happens when interest rates go up is it acts as a catalyst in the market. And it really accelerated our market back in January and February when those interest rates first started going up. It pushed a lot of people off the fence that were maybe waiting to make their purchase, pushed them off the fence into the market earlier this year than what we had expected. But now we're seeing a cooling trend, and that cooling trend is likely to continue through the remainder of the summer. Looking at what's been happening just in the last week, coming soon's dropped by 8.9%. So we saw fewer new listings making their way to market, but our average daily active count went up by 7.1%. We're now sitting at about 3,500 available units for sale in our marketplace, and that's up from 1 year ago by 64%. New listings coming to market was down by 9.2%, down by 1.4% from the previous year. Back on markets held steady at about 260 units came back on market. About 130 of those were in a previously under contract status. So that means that our fallout rate is about 8 to 9% right now for contracts going under and falling apart. That's drastically lower than what we would typically see. Typically, we end up seeing about 15 to 16% pre-COVID of contracts that would fall apart and then go back under. Expired listings and withdrawn listings are on the rise as we get towards month end. As we get through the summer season, spring selling season, we start to see that there are more expireds and withdrawns at the end of every month because people are choosing to pull their home from market in favor of waiting until possibly next year to list and sell their houses. Pending transactions fell by 1.1%. We put about 1,500 units under contract last week. Closed transactions came up by 9.6%, and this will jump next week just because we have month end and we have a lot of closings that happen during month end. Overall, our predicted month supply of inventory came in at 0.5, which is up from the 0.2 months of inventory that we were looking at back here over Super Bowl weekend, which was really the hottest weekend that we had so far this year in 2022. Looking at 0.5 months worth of inventory means that for every one buyer and one home for sale in the market, they roughly have 2 buyers per property. At the current rate of sales, we'll sell out of the existing inventory in about 14 days. Keep in mind that a market imbalance would have about a 6-month supply of inventory. And so we're far short of what we would need to offset demand at this point. Still not in danger of watching a bubble burst at all in our marketplace. The odds of selling dropped down to 75.2%, which is down by about 12% from where we were over Super Bowl weekend. We've continued to watch that odds of selling decline. That's still not a bad number though, because pre-COVID, the highest I'd ever measured that was about 65%. And so we're up about 10% still for the highest and best odds of selling that we had ever measured pre-COVID. So the market is still really good. It's just not as good as it was back in January and February for when we were in the heat of our marketplace. So the odds of selling, again, is basically where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And I project it forward for about a 4-week period of time. So again, it's 75.2% odds of selling. Looking at where we are for balance right now, we're at 8.6% of the market that we require to offset demand. And I keep hearing agents in the marketplace say, well, we're trending towards a more balanced market. And in theory, that's an actual accurate statement, but we're still so far from a balanced market. Again, we only have 3,500 available homes for sale. We would need to have about 40,000, 41,000 available homes for sale based off of what went under contract last weekend to make up that magical 6-month supply of inventory where the rate of inflation matches the rate of appreciation. That's a market in balance, not an average market, not a normal market, but a market in balance. It's a market where the rate of appreciation matches the rate of inflation. Looking at that, again, we only have 8.6% of the available homes for sale. We're still having talk about a recession that might be looming. And if we have a recession that might be looming, that doesn't necessarily mean housing recession. Out of the last 7 recessions that we've been through, only one of them did we lose home value. And that was the Great Recession of 2008 through 2012, where it was the housing market that led us into the recession. It was where we were upside down due to the types of loans that were being written. Those types of loans are no longer available, and we are so flush with equity that if a homeowner finds themselves in some sort of distress, they're able to list their home in a hot market and walk away with all of that equity that they have in their marketplace. Showing information. So again, this only accounts for showing time data. I would tack on probably another 2 showings through Broker Bay in order to get a full and accurate spectrum of what's happening in our market. But back here in January and February, for any new listing that you put up, you were looking at closer to 20 to 25 showings per property. Now we're down to about 5 shows per property per weekend if you put up a new listing. Again, I've been talking with some large teams who put up 5 listings last week. They said out of 2 of them that they didn't get any showings that happened over the last weekend, the first weekend that they put up a new listing. So keep in mind that you have to really reset those sellers' expectations that you may not be under contract in the first weekend anymore, because our buyer pool has withered due to rising interest rates and buyer fatigue setting in. We've got to reset those sellers' expectations to what's happening in our marketplace. Looking at the number of shows to go under contract, people are looking at fewer homes before going under contract. Now it's about 11.6 shows should yield you a contract, versus looking back here over Super Bowl weekend, we were sitting at about 26.6 shows should yield you a contract in that market. So again, people are looking at fewer homes. So if you've had a total of 12 showings and no offers, you may be in a position where you might need to reduce your price in order to go under contract. There are only 3 things that you can control about a property: location, condition, and price. Price is the one that you're easily able to change in a market in order to get a home under contract. So you might start having to have that conversation at the listing appointment that if we're on the market for X number of days, or we've had X number of showings and no offers, that we may need to go through and reduce our price. Pricing is paramount right now, and we're certainly not yielding the same types of prices that we were back in January and February due to the market shift that's happened, along with affordability. Median days on market actually popped up to 5 this last week. So homes are staying on the market for an extra day this week. Usually we don't start to see that number go up until we hit about the middle of July, where it starts to hit 5, 6, and 7. But now we're up to 5 median days on market. We'll see if that number holds true or not. But homes are sitting on the market a little bit longer. And what's interesting to see from a title perspective is that what I'm seeing is I'm getting just as many orders in on Tuesdays as I am on Mondays, where buyers agents are holding off on submitting offers until they know how competitive that home is going to be. And they're submitting their offers late when they're reviewed on Mondays, and now they're going under contract on Tuesdays. But my Tuesday order count is nearly as strong as my Monday order count for title and new contracts coming into the marketplace. So an interesting transition there. Price reductions went way up. They increased week over week by 4.7%. We're now sitting at 16.2% of everything that went under contract last week had a price reduction, and about 81% of them had no price change whatsoever. Only 2.8% increased their price in this last week. So again, price reductions are definitely on the rise, and it's a little bit different this year than what I've seen in the past. Historically, what I see is when price reductions start to go up, is that I start to see that there's more widespread price reductions at smaller amounts. We're actually seeing larger price reductions happen. And so price reductions are occurring on the realm of 5.1% off, or about $42,000 off of their original asking price to go under contract. And so those are some pretty significant price reductions that I'm looking at across the board. When we look at the market for under $500,000, that's 27.1% of our housing inventory. And we've noted a cooling trend that's also happened mostly in the last 2 weeks of our market for this particular price range, but we're starting to see more inventory making its way to market and fewer showings that are starting to happen in this particular price range. When we look at the market overall, we're sitting at 0.3 months worth of inventory, which is up from the 0.2 months worth of inventory that we saw back around Super Bowl weekend. Our average daily active count came up by 4.5%. We're sitting at about 627 active units for sale. Pending transactions increased week over week by 2.8%. They were up to 515. We're starting to see more closed and pending transactions. Pending transactions went up by 2.8%, but it's down by 40.5% from where we were 1 year ago. Odds of selling came in at 84%. There is a slight cooling pattern that is happening here as well. At our highest odds of selling back over Super Bowl weekend, we were looking at, oh, my slides are slipping around on me on their own. Hold on. My computer might be getting too hot out here in the sun. I might have to move inside. So looking at the cooling transition that we've been watching back over Super Bowl weekend, we had about an 88% odds of selling. We're now down to 84% odds of selling. So it's still very high overall, but you can see that there is a cooling trend that's happening over the $500,000 price point. We're still only sitting at about 4.7% of the inventory that we require to offset demand. So we're far from a market in balance at this point. In this particular price point, we would need to have about 13,000 available homes for sale, whereas we only have 627. So this market is in no danger of any sign of a correction that would occur. If you put up a new listing in this market, the under $500,000 price point hasn't seen as much of a decline in the rate of showings. We're still expecting to see about 10 shows per property in this particular price range. And so again, if you put up a new listing last week and you didn't get 10 showings on it your first weekend, you might not be in your sweet spot. And now I'm getting attacked by bees. And so about 10 showings per property on that particular price range versus the 50 that we were looking at over Super Bowl weekend. In this market, you should have had 12 showings should yield you an offer. So if you had 12 total showings and it didn't yield you an offer, you might not be in the sweet spot in your marketplace. We were still sitting at 4 median days on market for this particular price band. So again, this market is still moving very quickly with half the homes under contract in 4 days or fewer. We did see a slight increase in the rate of price reductions. There was 11.5% of the homes that went under contract last week had a price reduction, and the average price reduction was about $26,000 for a price reduction, or about 6.1%. So even a larger price reduction in this under $500,000 market to get things going again. In the $500,000 to $1 million price point, we're looking at about 60.2% of our overall housing inventory. This market tends to hit just a little bit later in the marketplace, whereas if you're listing in early May, that really tends to be your sweet spot. We start to see a lot more inventory make its way to market, but you can see the cooling trend that slipped in starting over Easter weekend, and we're watching a lot more new listings making their way to market, and also a cool down in the rate of showings that are happening in this market as well. Median days on market also slipped up in this particular price point. We're now sitting at 0.6 months worth of inventory, which is up week over week by 11%. So this market is opening up very nicely. Should provide you with some opportunities to get some buyers under contract this weekend if you're taking them out. Coming soon's declined by about 10.6%. It's up 76.4% from where we were 1 year ago. So a lot more coming soons. Our average daily active count rose week over week by 7%. So it's sitting at 2,165 total units available for sale. That's up 131% from where we were 1 year ago. We could see that decline from the under $500,000 market to the over $500,000 market due to the sheer appreciation that we've seen, where a lot of homes have jumped over that price gap going into this $500,000 to $1 million price point, which is why we're seeing so many more active units in this price range year over year. New listings dropped by 6.5%, but they're up 37% from where we were 1 year ago. Back on markets, we're at 144. So based on those pending transactions, again, about 8 or 9% of those were previously in an under contract state before they came back on the market. Pending transactions fell by 3.6%. We're up 17.5% from where we were 1 year ago, and closed transactions rose by about 7.9%. The odds of selling now sits at about 74.1% when I take into account all of the available listings that are for sale versus those that go under contract and or close in the same week, projected forward for a 4-week period of time, which is down from where we were back in Super Bowl weekend. Super Bowl weekend, we were looking closer to, oh my gosh, my computer's all over the place. I'm gonna have to move inside. So looking at the odds of selling, 74.1% odds of selling right now, which is down from where we were previously. Back over Super Bowl weekend, we were looking at closer to about 87% odds of selling. So again, we're watching that cooling trend as we go through. So the longer that you choose to wait until the summer months to get your home on the market, the less likely it is to sell in that first week. So again, you want to get your homes on the market as soon as you can. Again, avoiding this weekend, but waiting until next weekend to get that home listed for sale. There's definitely a huge drop off that happens after July 4th. So again, watching what happens as we trickle later into the summer months and we get closer to school starting, we start to see fewer of those people going under contract as we list after 4th of July weekend. In this market, we would need to have about 23,000 available homes for sale. Again, we're only sitting at 2,165 units for sale, so we only have 9.3% of the inventory that we require to offset demand. We're still a long way from a market correcting in this particular price point. Under 500, this 500 to $1 million, this is really the bulk of our homes that are operating in Metro Denver. If you put up a new listing in this particular price range, it was about 4.4 showings for the first weekend that you put up that new listing. If you didn't get 4 showings on that property, you might not be in the sweet spot in your market, and it may be strike 1. Strike 2 would be as if you've had total of 10.7 showings and no offers, that you might not be in the sweet spot in your market. And again, factoring in those broker bay listings, you could probably add another 2 showings to that before you get to a point where you need to reduce your price. So we'll call it 12 or 13 showings before you need to go under contract. 5 median days on market. So we crept back up for 5 median days on market, where half the homes were under contract in 5 days or fewer in this $500 to $1 million price point. I saw you come off mute. Do we have some questions?
One, how many showings did this range have at the height?
At the height?
Yeah.
So at the height of this market, sorry, my computer's all hot now. At the height of this market, we were closer to, what is going on? Work with me, computer. So in this market, The height of showings, the number of shows per property was up to 25.5 shows per property. And that was over Super Bowl weekend where we really saw that spike happen back in February. Now we're down to 4.4. So we're seeing about 20% of the showings now that we were during the height of the market. Are there more questions? Nope. So 5 median days on market, we saw price reductions increase drastically this week. The rate of price reductions was actually 18.3% of the homes ended up reducing their price based on the data from last week. And so a lot fewer, a lot less homes, a lot more homes are having to reduce their price in this $500 to $1 million price point. And I'm seeing those price reductions happen in about week 2 or 3. If they're sitting on the market for longer than week 2 or 3, that's typically when we're starting to see those price reductions come through. The average price reduction was 4.4%, or about $31,000 for a price reduction in this particular market. In the $1 to $1.5 million market, we're starting to see that cooling trend slip in. It just really started about 2 weeks ago, where we're starting to see more new inventory making its way to market, making it less competitive for sellers. And we're starting to see fewer showings that are happening at this particular price range as well. Median days on market are also starting to creep up in this price segment. We're now sitting at 0.8 of a month of inventory, which means that at the current rate of sales, we'll sell out of the existing inventory in about 22 days. Our average daily active count came up to 389, which is up by 1.8% from where we were 1 week ago. Back on markets, we're 15. And so again, we're seeing about a 4% fallout rate for this particular market right now. Pending transactions, there were 117, which is week over week, basically the same number that we saw last week. That's up 30% from where we were 1 year ago. And so again, predictive month supply of inventory is on the rise, indicating that this market is cooling, creating more opportunities for buyers. The odds of selling jumped up just ever so slightly week over week. We came up to 68.3% odds of selling. Typically what we would see back over Super Bowl weekend, we were up to about 78% odds of selling. So it's about 10% less now than it was back over Super Bowl weekend, back in the winter months. In this market, we only have 8.5% of the inventory that we require to offset demand, whereas we would need to have 4,581 available homes for sale. This market is in no danger of a market correction either. We're so vastly undersupplied with homes that we only have 8.5% of the inventory required to offset demand. In this market, you should have had 3.8 showings on a property, or 4 if we just want to round it up, because it's hard to get an 1/8 of a showing. So about 4 showings should have yielded you an offer in this particular market. And again, 12.5 showings should have yielded you a contract. So if you didn't get 4 showings your first weekend, or if you've had a total of 12 showings and no offers, you might not be in the sweet spot in your market. We had 4 median days on market in this particular price range, and it's bouncing between 4 and 5 pretty consistently. And so about half the homes are under contract in that first weekend. Rate of price reductions increased again this week. We saw that 14.5% of the homes that went under contract last week made a price reduction, and the average price reduction was about 6.8%. So it's almost a $100,000 price reduction in this particular price range for people to go under contract. In the $1.5 to $2 million market, which is the last market that I'm ever able to measure due to size, this only represents 2.8% of our overall inventory in Metro Denver. We're starting to see that cooling pattern just start to slide in the last 2 weeks, where we're seeing more inventory make its way to market, and we're starting to see the percent of balance numbers change and shift a little bit, with more price reductions occurring in this particular price range. We're still sitting at 1 month worth of inventory, and so that means for every 1 buyer in the market, there's 1 home available for sale for them. Coming soons, we're up 30% week over week. There's 13 coming soons, 173 average daily active count. That inventory was up by 16.9% week over week. New listings declined this week. Back on markets, there were only 5 that came back on market, and no back on markets the same week 1 year ago. Looking at our pending transaction count, 39 units went under contract, which was up by 11.4% from the previous week, and 41 closed transactions in the $1.5 to $2 million price point. Odds of selling is sitting at 65.2%, hasn't quite cooled as much as what we've seen for all other price ranges. At our peak of our market back here, we ended up seeing that our 75.1% odds of selling back at the end of January. So we're about 10% less than what we've seen overall previously. We have 8.5% 50% of the inventory required to offset demand, we should be closer to about 2,000 active units available for sale in this particular price range to get to a market in balance. You should have had 3.3 shows per property on this market. If you put up a new listing in the $1.5 to $2 million range in the last weekend, so that could be strike one. If you didn't get 3 showings on your property, you might not be in the target market. We're also looking at about 14.7 showings should yield you an offer. So again, if you've had a total of 15 showings and no offers, you might not be in that sweet spot. Median days on market popped all the way up to 7.5 this last week, or 8. Week over week, that's up by 87.5%. So some inventory is starting to age in this market. We'll see if that trend continues. Typically, we bounce between 4 and 7 median days on market up until about the midpoint of July. Price reductions were up a whopping 33.3%. So we saw a lot of price reductions come through in this particular price range. That was up week over week by 21.2%. The price reductions that we're seeing in this market were about 8.8%, or about $175,000 off of their original asking price for those units that did go under contract. In that $2 to $3 million range, we're really coming into the late season for this market. And so here's the heat map pre-COVID for what we're looking at. If you're listing in June or July, it starts to cool down just a little bit. And so we start to see that transition occurs even at higher price points as we're going through. I saw some questions pop up. Should we scroll through those real quick?
We have 2. Going back to your 1.5, so you might have to pull up your slide deck again. Going back to your 1 to 1.5 and 1.5 to 2 million, the average showings now versus at the height.
Okay.
I was going to interrupt you, but you shut it down too fast.
Yeah, I'm moving. I am thinking through. I've got an end of year assembly to go to. Let's see where I can find that. 1.5 to 2 million for how much they're down. So 1.5 to 2 million. So the shows per property were up to about 12.4, and that was over Super Bowl weekend. Now we're down to about 3.8 shows per property. So we're looking at roughly a quarter of the showings that we were seeing back over the heat of the week.
Perfect. And then 1.5 to 2?
1.5 to 2. In the $1.5 to $2 million mark, we were looking at about 8.8 shows per property. Now we're down to about 3.3, so just over half. We're down to about 40% of the showings that we were seeing previously.
And then April asked about, did we have a balanced market during the Great Recession? We did. During 2007 to 2011, we had more than 6 months supply. Some would say, I mean, we even bounced into a buyer's market during that time.
We did.
Because there's a lot of inventory on sale.
Yeah, we got up to our peak for detached single family. For our peak, we ended up at 8 months of inventory, which was definitely a buyer's market. And in the condo market, we bounced up to between 10 and 12 months worth of inventory during that recession. So there was a definite shift in that relationship between supply and demand.
Do you know further back, like even Y charts and Fred don't go further back than 2000? Do you have data or know that when we hit a balanced market before that, if ever?
I don't. We've always historically trended more towards a seller's market in Metro Denver. I would say that our average over the last 20 years has been about a 3.5 to 4 month supply of inventory. And so we're still even far from getting back to what we would consider average or normal for Metro Denver.
Yeah. That's it for the questions.
Awesome.
Yeah.
Well, I'll turn it over to you. I'll hang out for just a few minutes and monitor some stuff. I'll get you tagged in that social media post, and I'll turn it over to you.
That's fantastic. You know, listening to everything that Megan's saying and talking about where we are with inventory and the showings are down, inventory's coming up. We are nowhere near a balanced market. We have to set perspective for our clients, both for our sellers and for our buyers. When they see that their house hasn't sold in the first weekend and their stress level increases dramatically, it's really on you to bring out some of this data and show them that we are trending towards, as Megan says, far away towards a balanced market. But in that, we are simply slowing down slightly. I could say the same about home price appreciation. It's going to slow down slightly, but it's not going to go negative. I'm seeing demand slow down. We're seeing supply coming up. We are seeing opportunity for first-time home buyers, right? This is the time that if we're not dialing all of the clients that went and re-signed a lease because they got pushed out of the market because they didn't have $50,000 or $100,000 or $200,000 over asking, this is the time to talk to every down payment assistance buyer, every VA buyer, FHA buyer. They don't know that the window has been opened. I'm going to talk to you and show you the charts that you can use. It's going to show you that the interest rates are dropping, demand slightly dropping because the interest rates are higher, and inventory is coming up, as we just saw with Megan. We've got things happening. Now, we're still going to see volatility because the Fed is still meeting and they're still proposing 5 Fed rate increases this year. And I would say that the market hasn't fully baked in the quantitative tightening. They've baked in, obviously, the quantitative easing because that's over. They've baked in a lot of the Fed rate increases because at this point, this week, Powell came out saying that we're going to be on track. We're going to be on track for a 50 BIP increase in June, a 50 BIP increase at their next meeting in July, and then 25 bips the next 3 times that they raise the rate, 5 times in total. Now, they've also come out saying that they are open to changing course, right? Of course they did, because this is the most wishy-washy I've seen. So right now, Powell, really have a lot of respect, not loving the fact that he continues to change his story. So in the most recent change in story, we had a lot of stress in the market in January because of the quantitative easing and the speed by which it was happening. And then again in March, when quantitative easing was done, and there was the big stress factor about how much is the Fed going to raise the Fed rate. And everybody was talking about the fact that it might go up as much as 75 bips, but it didn't. It went up 50, and then it's supposed to go 50 again. And then he kind of confirmed that. And he even kind of said, we might even take our foot off the gas. We might pump the brakes. We might pause. And that might happen in September. And we might see the stock market benefit from that. And we might see interest rates slowly coming back into normal. I'm going to show you some ranges here in a minute that I'm going to tell you that interest rates are higher than they should be. They are. And there are opportunities to take advantage of that in the arms and the jumbos. So let's just jump in. I'm going to show you the slide deck, and we're going to go through kind of some of this together, give you the information that you need to share with your buyers, because buyers need to be out. And listings, just let them know it might take more than a weekend, but if it's priced right and staged right, it's also going to go, because there will continue to be buyers. We know that. We know that because of birth rates 30 years ago. So I'm going to share my screen. All right. All right. So yes, I get so passionate about this. I love my job, and I just love the fact that I get to serve you on a daily basis. So thank you for allowing me to do that. So let's jump in. The very first piece of information this morning, PCE came out, a little bit of news, really didn't move the market. I just want to point it out because it also is slowing down. It's kind of like everything is slowing down. We're off of this massive intensity that we've been seeing over the last 2 years. This is good, right? You have to remind people, like, this is good. The extreme that we were seeing is not normal. It's not sustainable, and it doesn't help anyone except for sellers building a lot of equity. And I get that, but it keeps people from getting in. It keeps people from being able to afford things. It keeps people from being able to do things. So this inflation is coming down just slightly. Now, the core inflation, we still have housing and wage increases. So it's going to take a while. It's going to come down, and then it's going to sit for a little bit, right? It's still high. It's still high. It went from 6.6 to 6.3 on the full index. And then on the core, it went from 5.2 to 4.9. It broke below 5, and that's a good news. So in all of that, that came out this morning. Here's the other numbers that were tied to it this morning, and something to be aware of. Americans love to spend. We just do. I don't care what you say. If we can't spend it out in public, we're going to have Amazon deliver it. If we can't go to services, we're going to spend for goods. If we no longer are excited about the goods that we've been buying, we're going to go back outside to services. So we saw that personal income increased slightly. This is good news, 0.4% month over month. Spending, though, increased 0.9%, which is obviously putting a crunch on savings. And with the Fed increasing the Fed rate, that's also going to increase the interest rates that you're going to get on your savings accounts. And with home prices going up, you want people to be able to save more. You want them to be able to put it in their account, take advantage of slightly better savings rates, but they're not doing it. This is half of the historic average of saving. So it just dropped down to 4.4. So it's a little bit of an issue. What you have on the flip side of this, which is not part of this report, but another report that came out, is a private sector income actually went up 12.7% year over year. So that equates to a little over 1% of a month over month if I was going to compare it to this personal income of 0.4. Private sectors typically are going to be higher, and that's going to be more in alignment with your home buyers. That was up 12.7. That's really good news, especially with the increase in the cost of everything. The other news this week is that we actually saw a dip in interest rates, a quarter. That was huge. Why? Why did interest rates go down? And I'm going to tell you, it wasn't just one thing, right? So a couple of things that happened this week. So Powell came out saying that we are going to be flexible at the point of time in which we need to start pumping on the brakes or pausing. He also said that we foresee that we're going to continue forward with 50 bips this next meeting in June and 50 bips again in July. It's what I expected. It's what everybody expected. It feels good to get what you expect. That's what was happening over the last several months, really since January and certainly since March. We were getting a lot of things that we didn't see coming. Nobody loves to be surprised except for birthday parties. So when we get surprised by what's going on in the economy and the direction of things, we see that this interest rate, all of this fast moving upwards. Well, now we're just coming back in line with where we should be. And I want to actually compare this to jumbos, because when I think about this, some of the things that are keeping interest rates high still and will is the inflation, right? Inflation is the arch enemy of bonds. Bonds gives us our interest rates. We also know that we have this flight of safety. We have what's going on globally, which is impacting the stock market. We're seeing the stock market drop, people pulling their money out of stocks and they're putting it into bonds. That's going to support bonds. That's actually going to support our interest rates. So however, we see the 30-year fixed is still slightly higher than it should be. And I want to actually jump 2 slides. So this chart, shows the spread between the 30-year fixed and the 10-year treasury yield. If I go back historically and I figure out a trend line, it's 165 bips different, which is 1.65%. Right now we have a 234 bip spread, and we really had a spread right here. When you're talking about right after the pandemic, what happened? Lenders got freaked out. They overpriced things. They padded things because they didn't know which way things were going. We all knew that. We talked about that back then, that the rates were really high comparatively because of risk, right? A lot of fear and risk. But then they started to squeeze down. Now they're spreading because there's a lot of premiums with FHFA. Because I can tell that because of where the jumbo rates are. Jumbo rates historically should be higher than conventional. It should cost you more for that higher loan amount. It's not the case right now. In fact, just priced out a loan this morning at 4.5% on a full doc jumbo loan, which is why we're looking at a lot of jumbo ARMs. We're taking advantage of the adjustable rate mortgages. We're taking advantage of the jumbo. And we can do that for a lot of clients, especially because the price points in Denver are higher. But that's how I know, based on the spreads and based on the jumbos being better than the 30-year fixed conventional, that interest rate is still being held artificially higher than it should be. How much? Maybe a quarter, right? But we still have opportunities to drop that down. Another couple of reasons why we might see an improvement in interest rates on FHFA as well as FHA, so Govy and conventional, is what else happened this week. So we actually got Julia Gordon, who is now the commissioner of FHA, the Govy loans, right? That was just done this week. She was brought in. And with Julia Gordon, you will absolutely 100% see the reduction of the mortgage insurance premium for FHA loans, as much as 3/8 to 1/2. Great news for Govy buyers, great news for those FHA buyers. It's going to drop off some of that upfront costs, and then we'll see if she starts to change the annual premium as well, which will improve affordability. So that's going to happen. But what's going to happen with that is FHA is going to continue to get more of those affordable buyers, those lower credit scores, lower price points. FHFA, which is Fannie Mae and Freddie Mac, has also a purpose to support affordable lending. We know that. We've been talking about that politically. We know that. Sandra Thompson just this week was confirmed as the FHFA director over Fannie Mae and Freddie Mac. She's been the acting director since the beginning of the year. But now it's a full thing. So she was just brought in, and her premise and one of the big ticket items on her plate is the fact that she wants to restructure the pricing for first-time home buyers and people of color. So how she's going to do that, we're going to see, but we're going to see, especially with Home Possible, Home Ready, some of the affordability programs, we're going to see some of those additional fees that FHFA puts on their loans dropped or reduced. So some of those interest rates are going to get better, and we have room to do it. I know that because of the way it is. I know that because of the way it is. Home prices are surging. Yes, they are coming back down again. We are seeing this slow in relationship to everything Megan was just talking about. We are seeing things slowly slow, right? And we want this. We want this. We cannot continue to sustain the 21 to 22% appreciation that the Denver Metro has been seeing. So we're seeing some of this come back down. This is a Moody's report, but a lot of this had to do, obviously, with the limited supply. And one of the things that we look at, not only do we look at existing home sales and new home sales, but we also look at vacancies. When you have limited vacancies, and right now we have some of the most historic limited vacancies, both for purchase homes and for rent homes. Both of these are going to continue to put pressure on home prices and on rent rates. Right? So those rent rates are not like softening like the rest of the market. I don't know that they've been keeping up with the home prices, but they're certainly not softening. So the alternative to not buying is renting, and renting is going to continue to have pressure because the vacancy rates are so low. We did just see an increase in inventory. We're seeing that on the local front. We're seeing it nationwide. We actually saw an 8% increase in inventory nationwide week over week. So not even year over year, but week over week. When we see that kind of inventory, we also see people are continuing to move about the country as they can work from anywhere. And this is going to help people level set where they want to be. As we see a little more inventory, as we see slightly less demand, we're also going to see some markets shift from being all markets on fire. Some markets will slow down. It's exactly the same as the homes that need curb appeal and price right and staged right. Some cities and towns are just simply not going to benefit from the ability to move anywhere, but we are seeing more inventory, which is giving those buyers more options. New home builds are actually down to 10% of the market now. They had traditionally been 15%, and they're becoming less and less. So the new home construction numbers just came out this week as well. And those numbers are not so strong, right? So housing starts is down 0.2% month over month. Interestingly enough, the single family portion of those housing starts is down 7.3%. We're seeing those builders, because of the continued cost of everything, we're seeing builders turn more to multi-units because they can make more for their money. We need to see more of those affordable houses being built. So those housing starts are softening. Completions is also down. It's down 5% month over month and 8% year over year. We're also seeing that median price point we're trying to get more towards affordable, but really even more important than that is there were 444,000 homes for sale, new build, 38,000 of them, of the 444,000, so 6% of them were actually completed. That's the problem that we're having. Even if they get started, right? Even if they are sold, they can't get completed. You guys are feeling that. I'm seeing it. I'm talking to folks that are with one lender and they've extended it 2 or 3 times and the builder still can't get it done and they're looking to switch to us. If you have any clients in that situation where they can't get their lender to drop their rate, given the fact that we've seen a slight decrease in rate, we should be talking to them. I would love to come in, see if we can help them out, especially with what we saw this week. Mortgage purchase applications are down. They were down 11%. Mortgage applications as a whole were down 11% last week, down 1.2%. This current week, mortgage purchase applications, not the refi, but the purchase specifically, were flat, but they were down 16% year over year. So what does that tell me? If I pull all of this together, I've got purchase applications are down because of the higher interest rates. I just got a small benefit from that this week. I see inventory is slightly up. I see a holiday weekend in front of us where we're talking about the fact that we have less showings expected. All of these are opportunities for our buyers, especially for our first-time home buyers trying to use Govy loans, trying to use down payment assistance. This is the opportunity to get them in. But what I know, no matter how the demand softens, not disappears, but softens, I know that it's still going to continue. We've seen this chart before. It continues to be relevant. So updated right here, we know that today the highest age groups are right below age 32. So we've got age 32 and age 31. The average age of a home buyer is 33. We still have some of the best years in front of us. And even birth rates, people keep talking about the fact that birth rates are down. The birth rates are down, way down here. The birth rates, they're still higher for the next generation than they were for my generation. Opportunities. We also have the strength of the home buyer. We're not going to see, and I've talked about this before, we're not going to see people selling a ton of their homes because they're rate locked. They've got locked in at a 2.625, and we'll never see that again. We just saw in March the highest originations of HECA mortgages, which is reverse mortgages, which means that people age over 62 are not moving either. They're refinancing, they're getting rid of their mortgage, they're taking some of their equity, they're putting it in other investments, they're buying investment properties, they're protecting their retirement, and they're doing it by staying in place. We have an extremely strong housing market and buyer pool. This chart actually shows you as a percentage of the buyers today, how many have a credit score under 700. This is just continues to talk about the strength of the market. Back in 2007, over 65% of the buyers had under a 700 credit score. You're talking about a 630, a 640, a 650. Today, barely over 20% have less than a 700 credit score. And meanwhile, our equity, which is the blue line, which comes over to the left side of the screen, is almost at a 70% nationwide, including those homes that are owned full, free and clear. A ton of equity, a ton of opportunity, a ton of possibility. This is the opportunity to talk about people maybe not selling. Maybe they convert that into a rental and they go look for the next home. We're doing a ton of cash out refinances and supporting HELOCs to pull that money to go purchase the next home. We're also doing a lot of bridge loans where people can take that equity, lean on their current home so that they can go buy before they sell. How do we take advantage of this information to capitalize on the opportunity to support our clients with a conversation about where they can go with real estate, how they can support their financial stability and security using real estate? Institutional investors know this, right? They know that real estate long-term is still the way to support that continued success, especially with the volatility that we're seeing in the stock market. That number continues to go up even into 2022, even when we're seeing higher purchase prices. This institutional purchases, whatever you think about it, is going to continue to keep rental rates high. It's going to continue to support the floor of home prices. We also have, as I talked about earlier, home buyers that are willing to move anywhere. We still, a third of our home buyers are looking to relocate. Not only is that opportunity to continue to cross market in other markets, but it's also the opportunity saying that people are still moving. People are still taking advantage of the opportunity to work from anywhere, and that's still opportunity for purchases. So MBA puts out a report, and they update this every single month with their expectations of where we're heading for both interest rates, for sales, and for originations. So this is both my business as a lender, your business as a real estate agent. I want to show you a couple of things that they're talking about when they're talking about home prices and when they're talking about interest rates. So as far as interest rates go, the 30-year fixed is right here. If I come across, they're expecting 2022 to land at an average 5%. A lot of that having to do with the fact that 5.5% was never the right relative 30-year fixed to where the 10-year treasury was. The 10-year treasury bounced above 3%. It's now back to 2.74. So that shouldn't be a 5.5. Remember, on average, we have about 165 bp spread between them. So it was high. So this is expecting the fact that we might even come down to 5% to get more relative. This is great news. It's not a reason to sit on the sidelines because home prices are expected to continue to go up. In fact, so here's the home prices, this red line. In 2021, we saw 17. We saw about the same in 2020. They're expecting home prices to go up just about 6%. Remember, this is going to be nationwide. Then they're expecting home prices to go up another 2.5%. in 2023 and 4.5% in 2024. What does that say to me? Home price appreciation is expected to slow down. It is not expected to reverse course. Remember in 2018, when interest rates went above 5%, in 2019, the Denver Metro saw an appreciation of 2. Is that awful? It's not awful. If I'm getting a 2% appreciation on a $600,000 or $700,000 or $800,000 home, and I use leverage and only put 3, 5, or 10% down, I'm loving that 2%. Plus, it allows buyers to get into the market. They can't get into the market at 22%, which is what we're seeing, or what we just saw in the Denver market as of March. CoreLogic's appreciation numbers will come out again next week. So they're expecting them to level off, not to decrease. Big news, because anybody that's waiting for this opportunity in interest rates is going to lose the opportunity in increased prices. I'd rather get in now and allow myself to take advantage of that appreciation and then lock in a lower interest rate down the road with a refinance. Here's what they're saying though. These are in units and dollars. So if I look up here in purchase dollars, if I go across, so 1.6, 1.6 million, 9, 1.7, 1.8. So these numbers, they're talking in billions, so not even millions. So 1.8 billion, 1.7 billion, these are originations, right? So I understand that they're not in sales in the numbers that you're talking about, but these origination numbers go to the sales that you're doing. These are purchases, not refinances. They're expecting the purchase originations to continue to increase. And you're still going to have cash buyers. Those cash buyers are still a significant portion of our business, or your business, not at all mine. So there you go. But as the purchase volume continues, primarily because of the increase in our home prices, those increase in home prices will continue to have the increases in the loans, the increases of the commissions earned. Meanwhile, the units are expected to stabilize. Right? So that's not a terrible thing. So maybe you can get paid more for working the same. I don't know how you can figure that out. But all of this is really good news to me. I was just watching a presentation yesterday and they were talking about originations to decline. Again, I understand that this is more of a loan term than a real estate term, but this also has to do with what you're selling, right? Because the yellow bars are refinances, but the greens are purchases. So we're seeing where the purchases were strong before the recession, and then they kind of leveled off those purchases. And then we've had strong, and we will continue to have strong purchase volume. But the apple falls harder from the highest tree, right? When everybody talks about the fact, well, I'm not having as good of a year as maybe last year, or maybe you are, maybe you have less transactions, but more in volume. When you compare to the last couple of years, what we're doing this year is softer, but what we're doing comparative to history is stronger, and the volume is stronger because the home prices have gone up. Again, I just go back to the fact that everything is relative in today's terms. We have to look at the trend lines, and we have to look at the relative position that we're in today and give that clarity to our clients so that they don't think, oh my gosh, the demand has disappeared. Inventory is coming online. I don't want to get on the market because this is the beginning of a bubble bursting. This is the beginning of the bottom falling out of the housing market. Again, perspective. No, we're softening off of the highest high that we've seen in 15 years. All right. I just had to bring this out because it's so ridiculously low. Forbearances, almost nil, almost nothing. Foreclosure activity is a bump up, but it's still not only extremely low, it's historically low. It's staying near the bottom. In fact, Lawrence Jr. had come out saying just this last couple of weeks, home prices in the meantime appear to be no danger of meaningful decline. There's an ongoing housing shortage, and properties listed are still selling swiftly, right? Generally seeing that a contract signed within a month. So properly listed homes are still selling swiftly. With mortgage rates rising, Union forecasts existing home sales to wane by 9%. Home price appreciation to moderate to 5%. And remember, your volume will remain strong because of the home price that we've been seeing. So I'm going to land with two things really quickly. The lease buyout program. I've got a ton of agents that are getting excited about this, and they're calling up past clients who signed a lease when they got crushed out of the market. We need to get back in touch with them and let them know that interest rates have dropped a little bit. Jumbo rates are even better. ARMs are even better. Interest rates have dropped and we'll probably see a little bit of a drop. They are not going down for forever. I'm not telling you that this is a new trend. This is an opportunity. We still see the Fed raising the Fed rate 5 times. We still have China on lockdown. We still have Russia and Ukraine. We still have quantitative tightening, which hasn't even been baked in yet. So we still have things where we might see interest rates be volatile for the rest of this year. I don't want to get our hopes up and go, well, interest rates are going to continue to go down because what Nicole said. No, I said we're going to see volatility. I'm going to say that I think our interest rates are a little bit higher than they should be. And there are things in front of us that will give us some of those benefits, including the recession where we always see interest rates drop, always. Lease buyout program. Let's get them into a home. Let's get them start to take advantage of the appreciation. And then we can refinance them using the refinance certificate that we're giving all of our home buyers the opportunity next year to drop that interest rate. And we secured a date and a location. We're doing the next big thing, 2023 at the Omni Hotel. If you've not been there, it is gorgeous. You're going to want to stay overnight. It's February 2nd and 3rd. Right? I moved it from the end of January to allow everybody to get their feet on the ground in January, kick off the month, kick off the year in the right way. We have an incredible lineup starting to form. I cannot start to wait to show you all of the folks that we have coming in speakers. I got my first speaker contract signed. And he's gonna kick off the 2-day event, and it is absolutely gonna blow your mind. So I wanna make sure that everybody gets signed up for the next big thing. We'll start marketing and talking about that here in the next month or two. All right, so with that, I'm gonna just really check our chat. Can you get into more why the jumbos are lower than traditional loans? Yes. And a lot of it has to do with the fact that the conventional loans are going to be backed by Fannie Mae and Freddie Mac, which are FHFA. Now, remember, they put on additional pricing hits to second homes. They've done it in the past to investment properties, and they did it to most recently high balance loans. So there are pricing factors that are not from the market, but specifically from FHFA. Now, we are going to see that as FHA, the Govy loans, as they change and reduce some of their mortgage insurance premiums, FHFA is going to have to change some of their pricing models in order to get more of those affordable buyers, right, that they have been positioned to support, especially given our current political environment. So they're going to have to come back in line with that. And a lot of it has to do too with, I mean, we're seeing the 2 and 10 year, it inverted again just a couple months ago. So we're seeing a lot of short-term and long-term risk. But right now, those jumbos are not necessarily being affected by FHFA. They're not. They're going to be, we have jumbo aggregators that are looking more what the bond market is doing and putting their interest rates relative to the bond market, which is where those 30-year fix should be as well. So with that, I'm going to tell you guys, if I don't have any other questions, what an incredible time to do what we do. What an incredible time to be the educator, to support our clients through the noise, through the stress, and through the fear. And if you have any questions at all, I'm working this weekend. I know it's a holiday weekend. I want to get as many first-time home buyers under contract. Let our team go to work for you. We're doing the non-warrantables. We're doing the 8 to 10 day closes. We're doing the waiving appraisals and loan availability deadlines. If you want to know more, give me a call. I hope you guys have a fabulous, fabulous holiday weekend. You guys take care.